Glad to know you're still with us. With economic uncertainty looming and market volatility on the rise, many investors are feeling anxious about their portfolios. How can you weather the storm and keep your investments safe? Here, we speak to a financial analyst about safeguarding your investments during challenging economic times. Well, her name is Nabila Mohammed, Research Analyst at Chapel Hill Denham. Thank you, Nabila, for joining me today.
Thank you for having me. Good morning.
Wow, I see we're wearing the same color. Interesting. But first, I'd like you to acquaint us with available investment instruments, in the Nigerian market and maybe a few others, outside the country. I would like us to begin from that before we then delve into, the main issue.
So, as you know, not just in Nigerian markets, even in the outside markets, we have different forms of investments. We have the fixed income instruments, ranging from the bonds, the CPs, the treasury bills, all those fall under the fixed income instruments. And we also have equities, that's the stock market. We have mutual funds, that's like traditional mutual funds that we have in the country and even outside the country. We also have alternative investments as well. That's the real estate, the infrastructure funds. All these are different forms of investment vehicles that investors can, use to have returns at the end of the day. So basically, those are the major forms of investments that you find everywhere, both within and outside the country.
All right, so let's look at the equities market in Nigeria because it seems to be the one in the eye of the storm, basically. So looking at that particular time, this somehow doesn't look like a good time for people in that particular sector.
So really, it depends on perspective because for different investors, they have different outlook to why they are investing in certain instruments. So wherever you are standing at, the perspective that you're looking at in terms of the investment opportunity that you've decided to go into is what will determine whether this time is right for you or not. And I'll give you an example. So if we're looking at it as an equity investor, if you have a long time horizon, you already know that you're locking in your funds in a risky form of investment, and that's what equities stock market really is about. So definitely we would see some form of volatility along the line, largely driven by maybe policies in the macroeconomic line, also driven by corporate actions, also driven by just basic market sentiments. And really the time, year to date, we have a return of around 31.3%, and it is quite a huge number if you're looking at year-to-date inflation. So if you are looking at the time and maybe lately in the last couple of weeks, we've seen some form of bearish sentiment in the market. It's not uncommon to have that, especially if you're an equity investor. It's just a matter of how long your horizon in terms of investment is and what really you're looking at in terms of that form of investment, which is the equities market. Equities market, like I earlier mentioned, is driven by a lot of things. Market sentiment is there, that's forces of demand and supply. We have corporate-related driven actions that would spur sentiments in that particular stock that maybe an investor is invested in. Just like we had news around PZ and how it's affected the share price. So some of those things are really what will drive market sentiment. And it is also very dependent on your perspective to investment. So if you look at this time where prices are depressed for some of the key stocks, it will be an opportunity for someone to take advantage and take positions in those stocks. But if it's also another person's point of view, the person might decide that I would want to, sell average my cost and sell and take profits for now and come back in when I feel the prices are much more attractive. So really it's a perspective thing and how you view the market in terms of investments generally.
All right, so looking at the equities market, I know that to a very large extent, the banking sector has really, dealt the market a heavy blow. So I'd like you to, just specifically address people, who are in that particular sector. What's your thoughts? What should they be doing? We understand the recapitalization thing is starting as soon as possible. But then what do you think? I mean, how should they manage their portfolio at this time, their portfolios?
So really, the banking sector is one sector that I feel like is very interesting, given all the policies around it that has come out since the start of the year. And I would describe the recent tanking in prices of the banking sector largely as a result of, I would like to call it a herd mentality, just everyone following what every other person is doing. Because when you look at the fundamentals, in fact, let us even start from the macroeconomic climate and see how favorable it is for the banks at this point in time. Yields are elevated, and we know that banks are in the business of lending. They are also in the business of trading, and that simply means that they are going to tap into this high interest rate environment, and this will feed into their interest income at the end of the year. So regardless of the recapitalization, which is even a 24-month long exercise, meaning they have a long time to even get to that capital levels as disclosed by the CBN, they are still going to be doing their business. Business will still be good for them, especially now that yields are at all-time high. They are going to tap into that, and they are going to translate that into interest income at the end of the day. So if you're holding stocks, if you're already an existing investor in those banking names, you should be looking at the long-term view of how this particular sector is going to play out. They're going to come out stronger at the end of the capital raising exercise, that's no doubt. They are still in the business of lending, and yields are elevated currently. So even in the short term, their profitability will still be strong. They will still declare dividends. We should not also forget that in the equities market, the banking sector also provides the most liquidity when we are looking at the volumes and value traded that moves the market on a daily basis. So all these are positive things that I feel at these depressed levels, if you want to still take position in these stocks, you will still see value in investing in the banks at this time, regardless of the recapitalization plans. Just looking at how their core business and how it will impact their profitability at the end of the day. So these are the things I feel investors should be looking at. It's okay to take profits when you see the opportunity, but when you have a long-term view, I mean, you shouldn't be worried about the current, the levels that we're seeing it, because if you look at the fundamentals driving the businesses of the banks, you would know that they are still in business, and the business is not just for the short term, but also long term.
All right, well, still on the equities market, are there other, sectors or specific stocks with strong fundamentals that may have been relatively safe, during this period for people who want to rebalance?
If you look at the equities markets, we understand that the macroeconomic environment has, largely affected how some of these sectors have responded. Let me talk about FX now. For the consumers, we know they were hit largely by FX losses given the devaluation that occurred last year, and also at the start of 2024. But then we are also seeing them taking measures to correct these losses. Is ranging from debt to equity conversions by some of these consumer names, even them just looking inwards and trying to make sure that they come up with innovative products that will be tailored towards their different consumers. It just simply means that this impact of the FX losses on their books is going to be short-lived, and we'll definitely see them rebound, especially when we start to see some form of stability in the currency. And besides, the outlook for the currency this year still looks positive, given some of the policies and the exercises that the CBN has embarked upon in order to defend the currency or defend the naira. So if that happens, we'll definitely see that trickle into the performance of the consumer names, and we'll see them revert back to the levels that they used to be pre the devaluation exercise, and also see them start to declare dividend again. Besides, we've also seen the likes of Nestle also come out to say that they are going to start to revalue their assets in order to come out of the negative equity position. All these are key things that these companies are actively working on in order to address the losses that they must have booked previously. And that will tell well for investors, because it also means that the company will be profitable going forward, And if the company is profitable, it would mean that shareholders would have something to enjoy. In fact, I wouldn't be surprised if some companies decide to reward their shareholders for not paying them dividends in this immediate past year by paying them some form of bonus or something going forward when they start to record profits. So consumer sector is also one very good sector to look at, given all the things that some of the companies therein are trying to do to come back to profitability. We also have the telcos as well, especially MTN. Even though we've seen the losses, that company is, is a very strong company fundamentally speaking. And if we look at some of the things that they are also doing to bolster their profitability, I mean, it is also good investment to look at as far as equities is concerned.
All right, so away from the equities market, I mean, you've said a whole lot. I'm loaded right now, and I think everyone watching is loaded also. But give us a sense of what's happening in the fixed income market.
The fixed income market has experienced something very interesting since the start of 2024. I mean, we've seen yields from an average of around 13% at the end of last year, almost reaching an average of 20 and above. In fact, sitting comfortably around above 20% on average. And it's largely because of what the CBN is trying to do, rein in inflation. So they are maintaining a tight monetary policy stance and hiking interest rates accordingly, mopping liquidity from the system. And also we've seen some form of support in that line from the fiscal side with the aggressive borrowings that they started the year with. All this translated to high yields in the fixed income market. And what we are seeing now, we even saw something remarkable happen earlier this year with the bond yields crossing 20%, something we haven't seen before. So really, the fixed income market is also such that if you are a new entrant into that space, you'll be buying at high yields, and that is very good investment, given that we don't expect this high interest rates to continue for a very, very long time. It means that at some point in time, there will be a reversal and we will see some form of appreciation in your returns on investment. So the fixed income market really has experienced some form of interesting turnaround, given just what the stance is generally in terms of reining inflation.
All right, so talking about mutual funds now, that seems like an instrument that spreads, one's risks, but that is also dependent on the percentage spread. I mean, if you have a mutual fund where maybe 40% goes to equities, you're still not, I don't want to say you're still not so safe. So, how should an investor in that instrument mitigate his or her risks?
So really, it is not even the headache of the investor to bother about how they should mitigate their risks. Largely the portfolio manager that is managing the funds. Yours is just to give them the money and
you know what, Nabila, this is more like a personal experience. I watched my money go down. I watched the interest wipe off, and then I watched my capital go down. I can't sit down and wait for.
I would say that for mutual funds, really, you should be looking at mutual funds that are well diversified. And if you're and you should, as an investor, you shouldn't just go and sit and wait and allow someone else to manage your money. You should also monitor the market. So if you want to invest in a money market fund, now is actually a good time, given that money market funds invest in largely liquid instruments, that's treasury bills, and we know what treasury bills yields are doing. We're talking 25, we're talking 25, 27 levels in terms of yield. So that really is one mutual fund that you should be looking at, given the current macroeconomic climate. Another mutual fund that you should be looking at are those that invest in dollar-denominated assets. That's the euro bonds. Because if we're factoring in the depreciation or devaluation in the currency on your returns, you would be in so much money. In fact, just to give you context, on a year-to-date basis, if we had factor in the devaluation of the currency, assuming you started the year with a $1,000 investment, you'll be talking 45% return year to date, which is above what the equities market is even doing. So if you want to really enjoy the mutual funds, you should be looking at mutual funds that are invested in what is favorable currently in the macroeconomic space. If you're looking at bonds, you've got bond funds. You're looking at money market instruments, you've got money market funds. If you're looking at dollar-denominated assets, look at dollar funds. So those are really the mutual funds that you want to be invested in order to enjoy returns on your investment and also preserve your capital.
All right, thank you so much, Nabila Mohammed. I listened so much that I lost track of time. Thank you for sharing your thoughts with us today.
Thank you for having me.
All right.